Good morning. Today is Tuesday, March 9th. Hope everybody is doing well this year and everybody's getting vaccinated as fast as we can here. It'll be nice to get back to some normalcy here as we move along this year. And certainly the markets are trying to tell us that those things are hopefully going to happen. But as always, we know they never come out as they're planned. So we're expecting, this year to be a normal, probably good growth year. But even in those years, we have a couple 5% and 10% correction. There's just things that come out of nowhere. And so this year will probably be no different, but we're encouraged by what we're seeing so far here. Market seems to be consolidating nicely. So it's could be some more upside potential before we see kind of our next correction. So we'll see how this goes here. This week and in the next 3 weeks, I want to come to you with, this is March. So the beginning really of our good old tax returns. Everybody's having fun doing these, I know. Most exciting month of your life. But I wanted to give you I want to give you a workshop here, and the goal here today is to provide some helpful information to those that are going to do your returns on your own, or maybe you've already filed your returns. Just want to give you some proactive tax planning ideas for this year and going into 2021. Before I get started, though, it's always important to review that there are really 5 areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, investment planning. Even though today's presentation is really about tax planning, as a comprehensive financial management firm, we try to always consider the impact of any of these recommendations we make, not just on one, but all of these areas for our clients. Proactive tax planning, this should always be a key focus when reviewing your personal financial situation. One of our goals is to point out as many tax savings opportunities and strategies as possible for clients. So this workshop will review some of the broad tax issues and some potential tax reduction ideas. As we go through this, please remember that not all of these ideas may be appropriate for your personal situation. This workshop is for informational purposes only, and we always recommend that you address any tax strategies with your tax professional. First, as we get started here, let's look at some helpful information for filing or understanding your 2020 taxes. In 2020, there was 7 federal income tax brackets. Here are the tables for 3 of the most common ways taxpayers filed: single, head of a household, and married filing jointly. The amounts in each bracket were slightly adjusted from the prior year due to inflation. The lowest bracket of the 7 rates is 10%, and the top rate is still 37%. Also, the standard deduction. Should you not itemize, it's shown for each category. The itemization, it's tough to get over that number now. That was all changed a couple of years ago. If you can still itemize, a major change that still has a big impact from the 2017 Tax Cuts and Jobs Act is that the state and local tax deductions that you can take, often referred to as SALT, it's limited to a combined total of $10,000 or $5,000 for married taxpayers filing separately for state income and property taxes. This deduction limitation is currently set to expire in the year 2025. But stay tuned on that as we go through the next 3 weeks. I think you'll find that on the table is to bring these things back possibly. So this is how the law states today, but stay tuned on this. Long-term capital gains, they were taxed in 2020 at favorable rates, so they can be more tax efficient than ordinary income. This is important. The rates are 0, 15, and 20%. So the reason it's important is these long-term capital gains are usually better tax-wise than many other types of income. Charitable donations are still tax deductible for those who itemize. However, if you cannot itemize, Starting in 2020 with the CARES Act, it created a new charitable deduction available to taxpayers who use the standard deduction and do not itemize their deductions. This new benefit, known as a universal deduction, allows for an above-the-line charitable deduction of up to $300. So to qualify, the charitable gift must be cash or cash equivalent made to a qualified 5013C charity, and it should have been made on or before December 31st, 2020. That will be the same for this year as well. As the tax form here shows, it's in the new line 9 on your tax forms. Retirement plan funding, it's always something that we want to be considering. If you've not already funded your retirement account for 2020, there's still time to do it up to your tax filing date or April 15th, whichever comes earlier. Definitely be exploring this. We've been talking to a lot of you already about this, getting you to maximize these out. Really important. Remember, it all starts at the tax return. If you're paying taxes and you can utilize one of these, it's better to give it to yourself than Uncle Sam. So call us if you need more help on this. We've been talking to a lot of you about it already, and we'll continue to do so. Overlooked tax items and the deductions. Reinvested dividends. I've talked to a lot of you about this over the last really couple, 3 years. Well, probably more than that. It's, these come from mutual funds, from your funds that really there's 3 ways to make money. You invest in a fund, you have dividends that pay out through the fund, through the investments in that fund. They'll pay dividends. The managers will be managing those funds, and you'll have capital gains. Those get passed to us, and they get reinvested into the funds for the most part. Some of you take them. For the most part, we have those reinvested. What happens, though, is those become taxable to you. And so when you go to do your taxes the following April, you have all these gains, but you may not have seen them. If you look in your December statement, you'll see them, and you'll see that they've all been reinvested back in. What's important about these, though, is they're taxed differently. A lot of your investment dividends, they're considered qualified dividends. We'll be talking more about this as we move forward, depending on the tax changes the next couple of years. But I've been talking about this for the last few months now. It makes sense to not only have a good portfolio and retirement plans, but it makes sense right now, the way the tax code is, to have a good portfolio outside retirement plans with good dividend paying investments, because they're qualified dividends, so they get taxed different than coming out of retirement plans is fully income taxable. So we want to make sure we're tracking these. The good news, the financial companies have to be tracking these. So all these get tracked every year. It's important, though, because when you go to sell that fund overall, when you reinvest these things, it increases your cost basis. So we don't want you being paid taxes again, double taxes on the same dividend. So it's important all these things get tracked. The other thing, carryover items from prior years. If you exceed your annual limits, such as capital losses or charitable contributions or certain tax credits, be sure that you into the next year are utilizing these towards any of your gains or income. And if you change tax preparers, that's where we see mistakes a lot. You forget to tell the new tax preparer. So be sure and communicate that. Qualified charitable distributions, QCDs. So this is for individuals 70.5 years of age and older. You can send your required minimum distribution up to $100,000 per year to a charity. They have to be made directly to the charity. And so we just have to make sure your charity is considered a qualified charity. And we'll talk about this here in a minute, but remember, your required minimum distribution age now is 72, but the qualified charitable distribution age still is at 70.5. Okay, let's look at some helpful proactive tax plan strategies for 2021. Again, the tax brackets still going to be 7 tax brackets, but they get the amounts in there and the itemized deductions, or the standard deduction versus versus the different tax brackets, they've all been adjusted for inflation. It's going to work the same way. Same thing with capital gains. They're still at the same favorable rates. So nothing has changed there at this point. This could be important this year. And again, we'll want to be watching. I'm going to do another next week. I'll send out another one on what they're proposing in Congress to change. And this is going to be one of those areas could be a pretty big change for people. Again, looking at your retirement plans, one of the things that we have found is people tend to wait till the end of the year, first part of the year, and fund things. And then pretty soon you're having to cough up a lot of money. It's tough to do. And from an investment standpoint, when you contribute money to your retirement plans, when you contribute money to any investment month by month, that's called dollar cost averaging. So when you're putting money into your 401k plan or your SEP or your Simple, and it's coming out of your paycheck every month, and usually people get paid a couple times a month, you're dollar cost averaging into the market by doing that. And we really recommend in IRAs, Roths, or Simples, if you have your own business, or SEPs, be doing this on a monthly basis. It just makes it a lot easier, a lot more affordable later on in the year. Gifting. This had a lot of questions on this here over the last few months. You still can gift up to $15,000 per person. You can gift it really to anybody, mainly though it's to family members. When you gift to a 529 plan, when you give money into a 529 plan for a grandchild or a child, you in effect have gifted money to that child. Same thing with IRAs. One strategy I tell people with, if you have a young teenager, whether it's a child or a grandchild, and they have earned income, a neat strategy at that young age is if they put $100 into a Roth, match that $100, or maybe you match $50, but incentivize young children to be investing and learning about investing. We really encourage that. But when you do that, again, you're in effect have gifted dollars to that child. So, but at that young age like that, over time, if children, once they come into their 20s, if they've been putting money into any kind of an IRA and then they start working, have a 401k, we didn't have those tools at those young age. So in that 10-year period, 15-year period, it makes a big, big difference. It takes the heat off 20 years down the road. When they get to be 40 years old, 45, they're going to come back and say, thank you very much. The new above the line charitable deduction we showed earlier for those who do not itemize, it increases to $600 from $300. For individual filers, it still stays at $300. So you get a little more. Again, this is above the line. So when you gift clothes or anything to charity, it's still important to hang on to those receipts because you can still take advantage up to this amount. And even though it seems small, every dollar counts. This is something I've been talking about with some of you over the last few weeks. A great year to be doing some tax projections, especially if you've come into retirement or in retirement. I've had some of you had a large, you've retired and you're trying to figure out where do we take dollars. It really starts at the tax return, always does. This is why we gather these every year from you and we're looking at this. And when you ask us to take money or you want to take monthly distributions, we're looking at these tax returns big time. And so, but as you're giving your information to your tax preparer or you're preparing your taxes, this is where you want to be thinking about 2021 and have them run some projections. We know at this point, we know what the tax laws are going to be for this year. You should be able to come out with some projections and take advantage. If you retired late last year, or you've just retired year to date at some point, your income is going to be lower. So now you have opportunities to do some different things while we have these low tax brackets, because we may not have them in a year or two. So this is Roth conversions. We'll talk about that. Selling highly appreciated assets and taking advantage of the favorable gains. This is what we want to be looking at this year. So let's talk about some other strategies we believe can be taken a proactive approach versus a reactive approach. Now's the time to do it. And that's why it's so important to have those projections done. This is a strategy. If you're close to the standard deduction level, but not, just barely over it, one of the things you consider doing is bunching your charitable donation to what's called a donor advised fund, DAF. As this example shows, someone who's slightly over the standard deduction each year can bunch 3 years of charitable contributions into a donor advised fund in year one. This could bring that taxpayer a much larger overall tax savings over, in this example, over 3 years. As the other side of the screen shows, from your donor advised fund, you can still give to your favorite charity or each year out of that fund. This is the time to be exploring this if it's helpful for your tax situation, to deposit cash, appreciated securities, or other assets into a donor advised fund, and then distribute the money to charity over time. If you want more information on this, we can talk about it in your reviews or call us. Roth conversions, we've been looking at this a lot over the last couple of years since the Tax Act of 17 was passed. What we're looking at here, again, the required minimum distribution, people that have died 2020 going forward, then the beneficiaries now have to have those dollars out over a 10-year basis, where prior to that was over their life expectancy. Well, we know we have traditional IRAs, we have pre-tax dollars and 401k plans, and then we have Roth IRAs. With Roth IRAs, they're after-tax dollars going in, growing tax-free, and then they also come out tax-free. So if your heirs inherit a Roth IRA, they have to have these dollars out over a 10-year period, but it comes out tax-free to them, versus pre-tax dollars, it comes out to them, but they have to pay taxes on it. So this is where we're looking at your tax returns. We're looking at your marginal tax rate. We're saying, okay, who does it make sense to be paying these taxes? Should you be paying them and absorbing these taxes while you're alive, and knowing that you don't need these dollars, and moving over to Roth, knowing your kids will inherit these dollars and they'll be able to get them tax-free? What marginal tax bracket are your kids in? This is what we're looking at. And in some cases it makes sense, in some cases it doesn't. In some cases, your kids are in a lower bracket and you're in a higher bracket now, so let them pay the tax. So this is what we're looking at. Another reason why we're gathering all these tax returns, we'll be doing again this year. Oh, by the way, too, on that, on this is another benefit when you're going into, oops, let me get back there. What's this there? Another benefit of going into the Roth IRA like that too is it's not calculated in your required minimum distribution once you reach age 72. So it can be a win-win situation. Again, some of the benefits of going to a Roth conversion, no RMDs at 72. It's growing tax-free. So if you live another 40 years, your kids will get all that tax-free, and you've paid the taxes now at a much lower rate. And again, tax rates probably only go up from here. So it's a great time to be looking at it, at all this. Qualified charitable deductions. Again, we talked about that for 2020. There's still a strategy for retirement savers in 2021. This allows retirement savers to directly distribute up to $100,000 to eligible charities straight from their retirement accounts after age 70.5 and not pay tax on these distributions. If you're charitably inclined, consider using part of all of your requirement distribution for this to your qualified charitable distribution QCD. Remember, we want to make sure that they are qualified as a charitable contribution 501c3, and this has to go directly to the charity. It can't hit your hands. So we've been doing that a lot for people. And again, 70.5, you don't have to take your RMD till 72. And stay tuned on that. There's discussions maybe going to 75. It's been bipartisan support in Congress. We'll see if that happens. It'd be good legislation. Going forward, again, we'll continue to keep communicating to you. This is the first of 3 series we'll be doing on taxes this month. Next week, we'll talk about the proposals that are coming into the Biden's proposing to Congress Whether it happens this year into next year, we're not sure, but we want to keep you abreast of what's going on because it will impact all our planning for you. All the more reasons why we need to be watching your tax returns. I've been asking all of you, later in the year, especially in the fall, we'll know what's going to happen. If anything's going to happen out of Congress, we'll be looking at tax returns and reviewing those and looking at all these things we just discussed and see what makes sense. And I want to thank you. It's your health and well-being is definitely our priority, always has been, especially in the last year and a half. It's just been quite the challenge. And we're here. Just want to keep staying in front of you as much as possible. It's been a tough time. And if you know anybody else that can use this information, please share this with them. Send this or give us their name and address and or email, and we'll email address, and we'll send this link to them. We can also put them on our mailing list so they can get the reports, the quarterly economic reports, our monthly mailers. We've got another one coming out to you discussing some of these tax issues. So that's going to be on its way to you probably next week. So if there's other people around you that friends or coworkers, other people retired, and they could use this information, we'd be honored if you could share the names of these people with us. We put them on our mailing list. This is how we grow. And with that, I want to say thank you. And remember, a proactive approach can many times lead to better results than a reactive one, always. So with that, have a great rest of the week, and we'll be coming back to you soon.